an example of how this actually looks like on your charts. So let me just illustrate this. So let's say this is resistance, and then price for a long trade, right? The price goes up, comes down, still green, change to black. Okay, ta-da! Okay, goes up, comes down, and then it breaks out higher. So price has now break up of resistance. That's number one. Then it has now retest, right? Previous resistance, which could become support over here. At this point, we have no idea whether the price will, respect this area or whether it'll slice through it, like a hot knife through butter. So this is why we are looking for a bullish price rejection. This could be things like, bullish candlestick patterns like a hammer, bullish engulfing pattern, etc. So let's say, for example, it comes up as a hammer like this. Okay, so now you have some bullish price rejection telling you that buyers are stepping in and they could push the price up higher. So what you can do is enter on the next candle open here. Stop loss is 1 ATR below this low. In other words, it's just a distance, a buffer below this low. I'll explain to you how to do that shortly, but usually your stops will be somewhere about here, your stop loss. And your target is just before the recent swing high, somewhere about here. So this over here, you can see is your entry point. This is your stop loss. And then this is your target. So simple stuff, right? So now let's have a look at some real world charts, right? So you can actually see, right, how this works in the in the live markets.